Hi, it's Jeremy Reiland with Vantage Point Financial. How does the Federal Reserve impact your retirement, and specifically when they're raising interest rates? So first, let's cover a few key terms you may be hearing in the news media. Things such as hawkish, dovish, monetary policy. What does it all mean, and what is the Federal Reserve trying to accomplish? So when the Federal Reserve is raising interest rates, that means they're being hawkish. The whole goal of raising interest rates is to slow down inflation and slow down the economy. Now, if they're being dovish, that means they're reducing interest rates and they're trying to spark the economy. So in March of 2022, the Federal Reserve began raising interest rates again. Now, if you remember back to April of 2020, the Federal Reserve lowered the federal funds rate down to near zero during the pandemic. The goal there was to try to spark the economy and give access to cash or capital more freely to individuals and businesses. So when you think of now when they're raising interest rates, which they've been doing pretty aggressively, how does that impact you? So specifically three categories. So number one, the stock market. So usually the stock market does not react well to a rising interest rate environment. So during 2020, the Federal Reserve started raising interest rates in March, and they pretty aggressively stayed the course the entire year. So the stock market reacted negatively. So overall, the stock market, the U.S. markets were down nearly 20% for the calendar year of 2022. And it happened very quickly when they started raising interest rates. So it did not react well. Now, usually in the past, when they've lowered interest rates, the stock market does like that. And generally in the short term, it makes the market go up. It's not a guarantee over the long haul, but it does definitely react to interest rates going up or down. Second are mortgage loans. So in January of 2022, you could get a 30-year fixed rate mortgage at about 3%. Now today, the 30-year fixed rate mortgages are about 6%. So they've doubled in about 18 months. So that makes it more difficult for people to be able to afford a mortgage. The rising interest rate environment is how they kind of help to control the monetary policy or money supply. So it definitely affects mortgages, auto loans, credit cards. The rising interest rates just make it more expensive to borrow money. Now there is a plus. The savings rates have gone up pretty drastically over the last year and a half. Just yesterday, I saw an 18-month CD at 5.1%. If we were to rewind a couple years, 2-3 years ago, you'd be lucky to get 0.25% on an 18-month CD in that range. That's been very, very low ever since the financial crisis. So we do see some positives. Now, if you're not borrowing money, with which most of you, if you're retired, you're probably not really borrowing a whole lot of money right now, so the mortgages might not affect you. Certainly the stock market volatility can affect your retirement. But being able to save some of your money at the bank to get a decent interest rate is a plus. So on CDs, money markets, savings accounts, fixed rate annuities with insurance companies, all those rates have gone up pretty significantly over the last 18 months. But most importantly, we can never really control or predict what the stock market's going to do, or really how the Federal Reserve is going to react to different things within the economy and inflation. So the most proactive thing you can do is make sure that your plan is efficient based on what you need your money to do. So I hope this is helpful, and we'll talk to you soon.